Okay, welcome back to Accounting 401, Chapter 6, Individual Deductions. Up until this time, we were at an introduction to individual taxation under the IRS code, and we were talking about income, various sources and types of income, which we'll revisit some later chapters, get a little bit more into certain things. Right now, we're going to be looking at the other side of the coin, things that reduce taxable income, individual deductions. All right. Now, there was major change on the Tax Cut and Jobs Act that went into effect that was passed on December 17th, 2017, and it significantly increased the standard deduction. And there's two ways, there's a whole bunch of deductions, but there's two major ways a taxpayer can claim deductions. They can take a standard deduction, which is calculated by the IRS based on all the tax returns that are submitted within certain parameters and standard deviations, realizing that everybody has these common based on the itemized deductions that are filed. So you have the standard deduction, then you have the itemized, where you can take the actual amounts and does all that, calculates it out to pretty much a what they call the standard deduction, averages it out. I don't know exactly the computations they do, but they take all the information they have and do this and do that and say, hey, this is about what 95% of the people would have. And it's a lot easier, simpler on both the IRS and easier, simpler for the taxpayer. They don't have to do the record keeping necessary to support any itemized deduction. So that's what Chapter 6 is about, things that are going to work to the benefit of the taxpayer by reducing their taxable income. Okay. And again, they start off with the nice story about Courtney and Graham, her mother. So it's always nice to read that. It makes it a little bit down to earth, practical. So deductions for AGI and from AGI. Okay, they start off with for AGI. AGI again being adjusted gross income. And these are things that the tax code allows people to deduct for. Deductions directly related to business activities, that would be on the Schedule C. Deductions indirectly related to business activities, and then deductions subsidizing specific activities. This would be things of a personal nature, your itemized deductions. Okay, so we'll get to the first two and what's a deduction. There's three basic rules. Okay. And if it's related to business activity, basic rule is within reason, any expense connected in the pursuit of generating revenues is deductible. It doesn't have to result in revenues or income, just the pursuit of income or revenues. But there's certain statutory, I don't want to put limitations on it, requirements that you have to meet. They have to be I'm looking for the exact wordage. It's a little bit farther down in the chapter. It has to be usual and customary and reasonable in nature. Okay, but business activities, we must distinguish business activities from investment activities. Okay, business is profit tax purposes. Business activities are for either profit motivated or are motivated by personal objectives. Profit motive activities are in turn classified as either business activities or investment activities. Business activities are sometimes referred to as a trade or business, your plumber, electrician, mechanic, accountant, tax preparer. And these activities require a high relatively level of involvement of effort, labor, okay, plus other things. For example, individual full-time employee, individual is in the business of being an employee. Self-employed individuals are also engaged in business activities. Tax preparer, paper, ink, my effort, my knowledge, but I also have to have a computer, have to have software, have to have office supplies, that kind of stuff, electricity. Unlike business activities, investment activities are profit motivated activities that don't require a high degree of involvement or effort. This is from owning things, owning stocks, owning bonds, owning a bank uh, certificate of deposit. You're going to get interest from it, but you really don't, you're not going there every day to the bank and, running a property. It's having a royalties from a gas well or oil well. You're not digging the well. You're not pumping the oil or gas out of the well. You're getting it because of a royalty payment because you're fortunate to have that deposit in your land. Yeah. Um, okay, so unlike business activities, investment activities are profit made that don't require a high degree of involvement or effort, and they involve investing in property for appreciation or for income production. Individual occasionally buys land or stock in anticipation of appreciation or dividend payment is engaged in business activity. And again, somebody that's investing in real estate versus a real estate agent, that would be a trade or business. You're selling houses, acting as a broker, as opposed to buying a piece of land and holding on to it for 5 or 10 years, hoping that somebody will develop something nice near to it and the price will go up. Distinction is important and it's critical for determining whether a deduction associated with that activity is deductible for AGI or from AGI, or even deductible at all. Okay. So it's not only, first thing we have to do, is it deductible, and then where is it deductible? Above the line or below the line? AGI. Okay. Exhibit 1 gives you some recap of what they're talking about there. Business related, investment related expenses. Okay, trade or business expenses. They have to be ordinary and necessary. And those are broad terms written purposely in the code as broad terms. And they pretty much go on a case by case basis, but common sense rules. Not only does it have to be ordinary and necessary, it has to be reasonable. Okay. There was a old time comedian on TV by the name of Red Skelton. You maybe see his show on black and white on some of these satellite channels. He hired his wife to be his traveling secretary. He would do comedy at different clubs and nightclubs and all over the country. And the IRS went in and disallowed the money he was paying her, and it went to court. I don't know. It might have gone to the Supreme Court. I don't know if it went that high or not. But he was able to demonstrate that what he was paying her was what he would pay a travel agent or somebody who was full-time engaged in doing what she would do, making train tickets, airline tickets, reservations for hotels, booking engagements for him, and that he was not paying her an excessive amount. Even if she was, the reasonable amount would have been a deductible. The excess amount, not deductible. Okay. A lot of business owners will put family members on the payroll for a little effort and pay them extremely high amounts, and the IRS will use the reasonableness test, even though it's not listed here. It may be listed a little bit later on in the book, but it should be listed here. Ordinary, necessary, and reasonable. And they are deducted on Schedule C for a self-employed person. Ordinary and necessary are as an expense that is normal or appropriate and that is helpful or conducive to the business activity. Okay. You take you meet with a client and you give them football tickets. Well, if it's to a local college game or even a Penn State game or even a regular NFL game, all right. If it's the Super Bowl and you fly them out there on the corporate jet, yeah, maybe you're getting out of the ordinary necessary. Regular season game, probably all right. Super Bowl, maybe not. Exhibit 6.2 is a Schedule C, that's where a self-employed person will show their revenues, their income, and also their expenses. Part one is income, part two, they're expensive. Well, part one is actually has a cost of goods sold in there if you're selling a product. So you get gross profit there. And you take a look at that line, there's 27 lines of specifically identified items: advertising, car and truck expenses, commissions and fees, contract labor, depreciation, employee benefit programs, insurance, interest, mortgage interest, legal and professional services, office expense, pension and profit sharing plans, rent or lease expenses, vehicles, other business property, repairs and maintenance, supplies, taxes and license, travel, meals, utilities, wages, and then 27A, other. So you turn it on the back of that Schedule C, and there's a line, I don't know, 8, 7, 8, 10 lines, and sometimes you'd have more than that. Because I had a client who was in the horse racing business. A lot of the expenses he had did not fit in these 26 categories here. Well, actually, lines 8 through 26. So we'd list them on the other because it's a unique industry, and they'd have things that I never knew what they were until I had to ask the client what they were. Feed for the horses, veterinary bills, that kind of stuff. Okay, rent and royalty expenses are reported on Schedule E. Okay. Schedule E on the front page part is for the rental of real estate. I had rental property, and I had clients that had rental property, and it was investment property because I had other means of income. I had a full-time job and a part-time job, and I had a rental property. I had clients, tenants in there that paid me rent, and I had expenses, property taxes, maintenance, utilities, all that kind of good stuff, depreciation would go in there, homeowners dues. Page 2 of that Schedule C, they don't show it here. Do they? No. All right. Page 2, the backside of that Schedule 2, you could go on the IRS website and look at that form, or they might have it in the appendix. Oh, no, there it is. No, I'm sorry, that's page 1. Page 2 is for royalty and subchapter S and partnership income. Okay, so what it says up the top: supplemental income and loss from the rental of real estate, royalties, oil and gas wells, partnership income, subchapter S corporations, estates, and trusts. So the rental of real estate is the most common. That's on the front page of that Schedule C. Back page of Schedule C would be the royalties, partnership, and subchapter S income. I didn't do my taxes yet because I'm waiting for my one limited partnership to send me the K1 so I can do the back page of Schedule E. Rental and royalty endeavors are most commonly considered to be investment activities, but they can raise to the, if that's what the person does for their livelihood, then it is clearly a trade or business, and different rules apply. Number 1, it's subject to Social Security taxes. Investment income is not. Okay. Like trade or business, rental royalty deductions are deductible for AGI. Despite preferential treatment, deductibility of rental losses is subject to limitations. Yes, there are a lot of deductions that are subject to statutory limitations. And we'll get more into this when we get into the itemized deductions. With the rental real estate, you can't deduct losses unless you're materially involved. And there's rules on that. We'll see that later on in this chapter, I believe, or a later chapter. Passive risk and passive activity loss rules in order to deduct a loss against ordinary income or W-2 wages or other supplemental income. Sometimes you have to carry it forward. Loss on the disposition of property. Okay, if it's a business asset, that it is reported on Form 4797. If it's a investment asset, it's on Schedule D. Okay. Capital losses exceeding capital gain, they can deduct up to $3,000 as a net capital loss in any particular year. Anything over that can be carried over into future periods until you use it all up. Flow-through entities. This is, again, on the page 2 of the Schedule E. This would be income from partnerships, LLCs, limited liability companies, and subchapter S corporations. They file informational returns, and then they give each owner a K1, and the partnership, LLC, or subchapter S files a informational return and all the K1s to the IRS, and the IRS will match it up looking for it on the individual to report it on their individual 1040. Again, if you have a subchapter S corporation with 2 shareholders, you got a regular guy making $100,000 a year, and the other partner is a multimillionaire making millions of dollars a year. They're in different tax brackets. The income from that rental property, the one guy's going to pay more tax on it, even though it's a 50-50 partnership. And let's say they make $20,000, $10,000 to each one of them. The regular guy is going to be in a lower bracket, 30% bracket. The millionaire is going to be in the 37% bracket. So same income from the same thing, taxed at different rates, given this individual's particular circumstance. Excess business loss limitation. Look at that, $524,000 for married individuals, $262,000 for other taxpayers. Okay, taxpayers are not allowed to deduct excess business loss for the year. Rather, excess business losses are carried forward to subsequent years until they're used up. Excess business loss limitation applies to losses that are otherwise deductible, but under the business at risk or passive loss rules are limited. Okay. Deductions indirectly related to business activities. Okay. Are related. Taxpayers are allowed to deduct some of these expenses that are indirectly related, some are not. Moving expenses, if incurred to move for a new job, are generally not deductible. Okay, the lone exception is for a member of the armed forces on active duty, okay, pursuant to a order from a commander. Incident to permanent change of station. Moving costs are not taxable if paid by the employer and deductible if the costs are not paid by the employer. Health insurance deductions by self-employed taxpayers. Again, the tax code not only wants to raise revenue, but it wants to encourage certain types of behavior among the citizenry. Health insurance is seen as a good thing, so they allow it to be deductible. However, employers often pay for part of it. And sometimes, where I used to work, they paid for all of it. Then towards the latter part of my career, I started having to pay for part of it. Each payday they would deduct. That's a fringe benefit. Does not apply to self-employed people. But what they do for self-employed people, they give them a allowance as a deduction for AGI, and gets it on the front page of the 1040 instead of on the Schedule C. What you pay for your employees is deductible on the Schedule C. For yourself, it goes before on the Schedule 1040. Self-employment tax deduction. Again, if you remember about the discussion on Social Security tax, half is paid by the employee and half is paid by the employer. If you are self-employed, you get to pay both sides. Well, it's deductible for the employer, so they give you there's a computational worksheet that you can complete and sort of evens out that inequity there that the self-employed person has to pay both the employer and the employee side of Social Security. Deductions for IRA accounts, traditional ones. Again, there's limitations on this. There used not to be, but they started putting them in. There are non-deductible IRAs also, but traditional, I forget what the limit is. And again, they change it every year. They bump it up a little bit for inflation. So they phase it out based on an AGI level. and after above an AGI level, you don't get to deduct. Within a $10,000 range, it cuts it down a little bit, a percentage, until it goes all the way. If